Let's get straight to the point. We are currently in a critical state where a strike is loaded but not guaranteed to fire. U.S. stock market investors should view a military strike as a high probability, high impact, but likely short duration conflict event. Probability of a military strike maintaining at 45 to 60%. This probability range is supported by both drivers and constraints for action. Drivers include, militarily, assets like the USS Lincoln Carrier Strike Group and Aegis destroyers are already deployed in the Persian Gulf and Qatar. The Pentagon's 72-hour action plan has been submitted to the White House. The hardware is fully in place. The political window is narrow. Trump canceled Oman talks on January 11th, stating bluntly that the military option is strong. European intelligence circles warned of action within 24 hours last week, later dissuaded by the White House, showing the situation is seesawing. On Iran's side, nuclear progress and internal alert levels are escalating in sync. The IAEA disclosed its stockpile of 60% enriched uranium has reached 410 kilograms, a new high since 2022. It temporarily closed its airspace twice on January 15th, simultaneously assessing airstrike risks. Ally attitudes lean toward acquiescence. Saudi Arabia and the UAE's protests over last year's Israeli airstrike on Iran were merely symbolic. A joint U.S.-Israel action is likely to face only verbal condemnation. However, constraints are equally prominent, balancing the resolve for action, risk of oil price spiraling. Internal U.S. calculations show that striking facilities around the Strait of Hormuz would push the national average gasoline price above $4.50 per gallon, unfavorable for the midterm elections. Fiscal and force shortfalls. The CBO just raised its FY 2026 deficit estimate to $2.1 trillion. Waging another air-sea battle would require an additional $80 to $120 billion in emergency funding, already facing backlash from deficit hawks within the Republican Party. Uncertain termination capability. Iran's Fordo facility is buried 0.5 miles deep. It would take 2 to 6 consecutive hits from GBU-57 bunker busters on the same spot to penetrate. Furthermore, Iran has dispersed some centrifuges to civilian areas and tunnels, making a guaranteed one-strike wipeout impossible for the U.S. military. Should a strike occur, the impact on U.S. stocks could vary across short, medium, and long terms. 48-hour safe haven reaction. The S&P 500 could drop 1.8% to 2.6%, with the VYX surging to 22 to 25. Brent crude could rise 8% to $85, and gold could spike to $5,100 to $5,150. Quantitative funds, upon triggering their thresholds, might sell an additional $42 billion in assets, dragging the S&P down another 0.4%. 2 to 4 weeks of valuation compression. If the conflict escalates, the S&P 500's P/E ratio could fall back to around 19, with the index dropping 10% to 12%. If the Strait of Hormuz is partially blocked, RBC models suggest the S&P could fall 18 to 20%, with EPS expectations for high oil consumption sectors revised down by 4 to 6 percentage points. 1 to 3 months of earnings transmission. For every $10 rise in oil prices, S&P 500 earnings growth slows by 1.1 percentage points. If Brent stays above $90, Q2 to Q3 EPS growth expectations could be revised down from 8% to 4 to 5%. Inflation expectations could rise by 0.3 to 0.4 points, erasing market pricing for 2 rate cuts. Financial stocks might benefit, while the tech-heavy NASDAQ 100 could face an additional 4% to 6% valuation discount. In summary, while geopolitical conflict risk could deliver a significant short-term shock to U.S. stocks, it is unlikely to alter their long-term trajectory. The key will be the market's actual reaction if and when an event occurs. As long as global investors' expectations for U.S. corporate earnings growth and market appreciation remain intact, the initial wave of selling could potentially create a golden buying opportunity.